Hello and welcome. My name is Brian Caplen. I'm editor of The Banker. My guest in the studio today is James Chappell, who is banking analyst for the private bank Berenberg. James has strong opinions about banks and does not share current market optimism about a recovery in the European banking sector. He recently wrote a report, and I quote, saying there are very few banks globally that you can invest in. Historical performance supports that. So, James, welcome to the studio. But I mean, the market is quite sort of upbeat on banks and seeing, rising rates and earnings going up. Why have you got a different view?
Well, I think it's about perspective. I think a lot of people see rising rates, believe that's positive for economies, and that banks are geared into that. I think for us, when we look at the European banking sector today, there's really two key problems that the European banking sector is facing. One is too much debt on their balance sheets. And the second thing is that margins remain too low in terms of what's going on. And really, until European banks address both those problems, it's hard to see them addressing the long-term underperformance you've seen from the sector.
So what can they do about margins? I mean, they're hoping in a way that the interest rate rises are going to bring back some margin, and you're saying it's not going to happen.
Yeah, I mean, it's very interesting, isn't it, when you look at the European bank sector, that one of the things people say is the European bank sector's margins are lower than those in the US. Why? Because of the difference in balance sheet mix. But actually, if you adjust for credit costs and you look back over the long term, European banks have always had the lower margins. What does that reflect to our mind? Well, I think it reflects I suppose it's the socialist type of banking model where the banks supported corporates and governments, and in turn, they ended up with helpful regulation within that. But what it has meant has been that there's been this economic profit transfer from the banking sector to other parts of the economy. And as a result, the sector has always underperformed when you look at it over the long run.
So what you're saying, in a way, is we're in a kind of sort of new era where the banks have got to stand on their own 2 feet. They've got to sort of factor out that kind of support for private credit and start to really make a profit in their own right. And do you think that hasn't quite come through psychologically yet?
Yeah, I mean, I think the difficulty they have is that, and to my sort of earlier point, is they've got too much debt on their balance sheets. So you're left with this difficult situation where you've granted this credit as part of your model that supported various companies within your own country. But you don't want to write that debt down because that results in job losses and in terms of what's happened. So you end up with this zombification, this forbearance, which is very similar to what you saw in Japan. And the OECD wrote a very interesting report about this. But what it's meant is that there's no investment, there's no pricing power in terms of what's going on. And that really Italy is the prime example of that, where these loans are allowed to continue. And actually the issue has been, with rates being cut, banks have been able to pay the interest on it. So the banks turn around and say, well, these are fine, these are performing. But actually, if you look at where the focus is now with the SSM, with the ECB, it's really on addressing those NPLs. And Europe, unlike the US, has has kind of used time to kind of deal with the problem. Whereas I think the US very much dealt with it in 2009, and as a result, you've seen economic growth be stronger as a result of that.
All right, so how does the UK fit into that? Is it closer to the US or closer to Europe?
Well, the UK's sort of partway in between. What the UK did in 2012, I think, is that they did their own comprehensive assessment within that, where they went through and looked at commercial real estate in particular in terms of getting the banks to clean up their balance sheets. And I think what you've seen as a result of that is you've seen loan growth pick up to a greater degree than you've seen in Europe, a little bit behind of what you've seen in the US. And as a result, it's helped economic growth. It has been in consumer credit, which obviously raises its issues for the future, but the UK has dealt with it more than Europe has as a whole.
Now, the other thing we've got is we haven't got the same sort of benign regulation that you talked about in the past. We've got things like the net stable funding ratio. We've got loan-to-deposit ratios that are much closer to 100% or less now. I mean, that's going to have a big impact on earnings as well, isn't it? On the long term, not just on the cycle.
Yeah, I mean, going forwards, I think what's been very interesting is if you look back and you look at when European banks have outperformed for a period, it was when they took on a lot of leverage. And if you look across the system globally, be it in the US or Europe, banks' business models are still very much dependent on leverage. And everything you see regulators doing today is effectively bringing regulation down in the system, be it in the UK.
Bringing leverage down, yeah.
Bringing leverage down, be it in the UK where they're looking at mortgage risk weights, be it in Europe where they're looking at the definitions of capital in terms of what's going on. It's all designed to bring down that leverage. And then on the liquidity side and the maturity transformation point you mentioned, the NSFR starts in the US in 2018. As a result of that, you need to match fund your business both in currencies and in term, which limits that maturity transformation. Now, that isn't in place yet in Europe, but it is part of the regulation. And so from our perspective, when you think about returns in the long run, we're heading back to that sort of 8 to 10% area, which is, if you look at the US over the very long term, over sort of 145 years, the average ROE is, 9.4%. That's the area we're heading to. And it's not necessarily a bad thing.
But that's realistic.
Yeah.
James, thanks very much.
Thank you.